Gold has been in an uptrend since March 2024, rallying from £1,600 per ounce to today's £2,330 an ounce. That's a gain of 46%. So, should investors be a little bit worried about gold being overvalued? Before we get into what the evidence suggests, at the end of this video, I'm going to share quite a very interesting insight into what's going on with our business and how buyers and sellers have changed their dynamics with this rising market. It can be very difficult appraising gold because, unlike a stock, it doesn't have any revenue or profit margins that you can gauge to see if a stock is over or undervalued. And when it comes to nominal valuations, technically gold doesn't have a top because fiat currencies don't have a bottom. Because unlike commodities such as oil, fiat currencies don't have a price floor. If the price of oil went close to zero, then no one would produce it. But if the pound went close to zero, it would still be produced and arguably in much higher supply. How do analysts know if gold is expensive or if it's cheap? The answer is to compare gold's purchasing power against other assets. How many ounces of gold does it take to buy the average property? How many barrels of oil does it take to buy an ounce of gold? And how does today's ratios compare historically? Auronum publishes articles discussing research related to precious metals, and videos on YouTube capture only a small proportion of the articles that are published on the website. You can keep updated with our findings by using the link in the description of this video. This week we published an article which discussed gold's value against oil, and excluding the 2020 lockdowns, the amount of oil needed to buy an ounce of gold has not been as high as it is today since at least the mid 1940s. It takes more oil to buy an ounce of gold than at any point in most of the people watching this video's lifetime. But that's oil. What about shares? We reviewed the value of the FTSE 100 contract, which is currently at 8,700, and looked at how many ounces of gold it would take to buy one of these contracts through time. It takes just over 3.7 ounces of gold to buy a FTSE 100 contract. This is the lowest amount of gold needed since 1984. To be clear, the FTSE 100 contract value is the lowest against gold that it has been in 41 years. If you're in the UK and you Google house prices in gold, you'll see the Auronum article which goes throughout time to see how the average house price has performed against gold. You will see that currently it's 128 ounces to buy the average UK property. This is actually the lowest amount of gold that you would have needed to buy the same UK house since 1985. We've touched on gold and oil, gold and UK property, and also gold and the FTSE. But what about other precious metals? Let's take a look at platinum because that is a really interesting case. Perhaps most interestingly, back in 1985, an ounce of gold could buy you 1.2 ounces of platinum. It now buys you just over three, meaning that gold has outperformed platinum so much in the last 40 years that platinum is now only worth half of what it was in the mid 80s compared to gold. The platinum gold ratio is an interesting one to observe because at the turn of the millennium, an ounce of gold could only buy you half an ounce of platinum. So we know that gold is relatively highly valued against some of the assets that I've discussed in the video. But what about the physical market? So we know that gold is relatively highly valued against the assets that I've discussed, but what about the behavior of the physical market in gold? In 2022 and 2023, the gold price was relatively stable around £1,600 per ounce. And what was quite obvious was that every time the gold would go up and put in a short rally, there was an increase in sellers. So anyone that sold into these rallies and then waited for the price to come back down could have bought their gold back at a much lower price. It's almost as if they were being rewarded to sell the rallies. And I think that people were becoming conditioned that when the gold price goes up, you sell. The problem with that is that I knew that one day there was a very strong chance that the gold price would start to go up and then it wouldn't come back down. And that's what we saw. During this period, when the gold price went up and broke out on the upside, there was a very interesting dynamic in the market because what we saw was a flood of sellers. It was actually quite hard to surface the amount of sellers that we were getting in that period. The result was that a lot of stock entered the market, which had been sat on for some time. Because there was so much stock available, the premiums, especially for numismatic coins, absolutely collapsed. There was so much stock available that the premiums went down and buyers had a lot of choice at around the spot price. As the gold price continued to go up, the amount of sellers was still outweighing the amount of buyers, and the premium stayed very close to spot. In the UK, this was especially seen for Krugerrands, gold maples, and gold eagles. The market shifted focus onto capital gains tax free coins such as gold sovereigns and gold Britannias. Recently, though, mostly January 2025 to today, I've noticed that the amount of selling has begun to taper. And supply and demand are very well balanced now. When we put stock available on the Auronum website, normally it only takes a few hours to sell out. Since the beginning of 2025, I've noticed a shift in the patterns of buying and selling. There's much less selling now than what we've seen. It was relentless for months, it's now slowing, and the amount of buying roughly matches the amount of selling. The market's in quite a good equilibrium point at the moment, despite trading near record highs in sterling. I think there's two reasons for this. Some of the sellers have been exhausted, they've been shaken out of the market already, so it's only really the strong hands that have held until now that still have stock. And what I think's happening is that where the gold price keeps going up, even the sellers have turned a little bit bullish and they're waiting for higher gold prices. The buyers have that fear of missing out. Perhaps they've waited for a dip and the dip just hasn't come. So now they're starting to come into the market and demand is much stronger because of that. So I've showed a little bit of evidence that gold is at an extreme valuation against other key commodities, but that doesn't mean that we're going to see a crash in the gold price. What could happen is that the gold price stagnates for a little bit. Maybe you do see some downside, but then those other assets outperform and normalize the valuations. Anyone that's read our article, Is Gold Overpriced, will see just how much the gold price corrected from the 1980 peak and also in the 2011 peak in terms of percentages. So you would have a rough idea if we did see a deep correction, just how much that might be based on what we've seen in the past. However, you don't necessarily need to see a big correction in gold. We could just see some stagnation in the gold price. What do you guys think? Let us know in the comments because it would be really interesting for everyone to see what the current sentiment is in this market.